Okay, thank you very much. I'm happy to open the last session. We're going to hear about firm networks and technology diffusion, and then about distributional effects of carbon pricing. So thanks so much for being here. And Paulo, you can start.
Thanks a lot for including our paper in this great conference. I'm really proud of being here. And this is joint work with Katherine and Daria and Hannah. Katherine and Daria are in the audience, so they can also participate in the Q&A. And the motivation for the paper is that there's a lot of evidence now that the speed with which new technologies spread across countries is key for explaining cross-country differences in economic performance or uneven development. Myself and Daria were part of the team that produced the WDR in 2020, where we focus on trading for development in the age of global value chains. And a key question that country representatives have, and economists in general, is how do firm-to-firm relationships and multinational chains in the context of global value chains contribute to this process of technological diffusion? Of course, we emphasize the static gains from trade that normally happen with global value chains, potentially at a finer scale. But this question of how much or the mechanisms. And typical surveys at the firm level, we have information on capital in general, but not really on specific technologies, especially in the manufacturing sector. So there is a big data gap here that prevents the researchers from looking at this. And so in this paper, we take an approach that allows us to study the diffusion of 29 new technologies across 17 countries in a relatively recent period from 2014 to 2022. Using texts of job ads. Similar to Orbis, but has this peculiarity of having very detailed information on firm-to-firm relationships. So faster diffusion as measured by the proportion of jobs that mention these technologies. We also find that linkages outside these firm boundaries are driving these results. As emerge in the US, we find that the role of buyers and innovation partners in speeding up diffusion happens not just within the US, but also outside. And so we contribute to mainly three literatures, the cross-country literature on technological diffusion that I mentioned already, which doesn't have this granularity that we need to tackle this question. We follow an approach for these job ads data that follows closely this paper by Bloom et al. That focuses on the US only, and so they provided stylized facts on diffusion within the US, but we followed a lot their approach in terms of the data sources we use, but at a broader level, and the approach to infer technology adoption from job ads. And we speak also to this literature that is fairly broad on productivity spillovers through M&Es and firm-to-firm linkages, but here researchers were not really able to say that that was a particular role of technology. It was just broader evidence on TFP or other measures of firm performance. So the data component is really important in this paper. It's a paper on diffusion, so it's inherently a bit descriptive. So, but the fact that we were able to get all this new data, both on job postings and firm-to-firm relationships, is a big component of the paper. So we scrapped online job hours from Lightcast for 17 countries, the US as in Lepot, but also in other countries like the UK, Canada, and then 11 EEA countries. We have data for the period 2014-2022, with covering more than 573 million job ads. The coverage is relatively good, given that these are relatively high-income countries. There is some variation in terms of the representatives of this data in terms of the total labor market. But for example, for the UK and the US, there is evidence that these online job postings cover about 85% of total vacancies. And we would expect that technological vacancies would be even more. All transcripts, presentations to investors, press releases, company websites, news reports, to assemble this data in a systematic way. And a clear difference between this data and others is that it has information on the main buyers and suppliers and innovation partners of these firms, which allows us to look at the international level. So it allows us to link firms in different countries and follow the diffusion of these technologies through these firms. Or actually the fact set contains about 170K firms, and we also have, for a subset of these firms, data on sales and net income and so on. So a big task was to match these two data sets. We used company names to do exact matching and fuzzy matching, and we got a very good final match rate of the fact set firms to the Lightcast data on job ads. And we have then, in the end, we have more than 100,000 firms in 17 countries. These are relatively large firms within each country, because the companies that FactSet gets the reports from are companies that are listed typically, and so on. So to measure diffusion of new technologies, we extracted from the job adverts these 29 technologies, new technologies identified by Bloom et al., with 305 technological keywords. First set of stylized facts, we're going to use a number of measures of dispersion that have been used in the literature, the Gini coefficient and the coefficient of variation. So what technologies the data covers? So mostly the job ads relate to technologies, to 5 technologies: social networking, cloud computing, smart devices, machine learning, AI, online streaming, and Wi-Fi. And so most of the evidence refers to this technology, even though we have a broader set, and we cover all in the empirical analysis. But keep in mind that it's mostly about this technology. This technology emerged relatively recently, so we can track the diffusion since the moment that they emerged until more recent years. One reassuring piece of evidence is that when you correlate the job ads that feature these technologies with earnings calls transcripts, which are essentially sessions where the CEO or CFO of a company talks with shareholders and press members of the press. There is a high correlation for each technology between the share of job ads that mention a particular technology and the share of earnings calls that also mention that technology. This is reassuring because it suggests that we're actually using two different sources of data and we are getting very similar correlated patterns. When you look at job ads, we see that in the cross-section, richer countries tend to have a much higher, significantly higher share of tech job ads. This is in line with the literature, cross-country literature, which is reassuring. Yeah.
Just to fix ideas, like, could you give us an example? Like, there's a new machine learning technology, and like, what's the term that would pin down the diffusion of that? Like, just give me like, it's not just like machine learning expert, right? Like, that's too broad.
In the job ad, it would be either mentioning machine learning or another synonym like artificial intelligence and so on.
So it is as broad as just like, it's not like machine learning and then using whatever, this new platform, or it's not specific.
It's not specific. It's in the job ad having this, but that's the approach that has been taken by the literature. It's in this sense, we don't innovate. We follow the literature.
So
yeah.
more related, just conceptually, should I think about each technology as a production function, and then the job proposal is to hire someone who can be an input into that production function, or is someone who is going to help develop that new technology or apply that new technology?
It can be both. It can be both. So it's really broad in that sense. It's just a job posting that is somehow related to a technology. I mean, you can, of course, go deeper and then try to distinguish this, but at this, given the objectives of this paper, we are, and following the literature, we are just incorporating both here. So, also, in line with the previous literature for the US, we find that across countries, and in line with the literature using other methods to measure technology, we find that across countries, as time goes by, since emergence, you see that the measures of concentration tend to decline. So within each technology, you see a greater dispersion of these job ads. So this is an indication that both across countries and across country regions, there is diffusion in the sense that the Gini coefficient goes down as time goes by since the emergence of this technology. And we are able to, following this paper by Bloom et al., identify the pioneer location, so where this technology was developed in the first place, and then construct a measure of distance to these pioneer locations, and then do analysis of the extent to which, once you account for a number of fixed effects at the country and time level, distance is correlated systematically with the share of job ads that feature these technologies. And we find both across the 17 countries and within the US that the farther you are from this pioneer the further you are located from these pioneer locations, the less likely it is that you have job ads mentioning these technologies.
So the pioneer locations was based on patent data, not
right.
Based on the actual job ads, right?
Right.
Okay.
Yeah. So basically, we use the locations that were defined in this paper by Bloom et al., and they use patent data to define it. So you see the same in the cross-sectional regressions. The coefficient on income per capita is always positive every year. The coefficient on distance is negative every year. And we're also able to do this at a firm level. So at the firm level, we are able to compute distances from these areas where the technology emerged. We have here nearest distance because the same technology, this is done at technology level, and the same technology can have two pioneer locations. So this is the nearest distance from the firm headquarters to the nearest pioneer location. And we find again that even when accounting for firm sales, the further you are as a firm and country fixed effects as well, the further you are from this pioneer location, the less likely is that you have job ads mentioning this technology. So the key, in addition to confirm with pioneer firms. So just some style facts before, we find that we're able to identify Fortune 500 firms, which are a relatively small subset of leading firms. And we see that when you include Fortune 500 firms, their affiliates, their buyers, suppliers, and innovation partners that are present in the FactSet data, you see that you account for nearly 30% of all tech-related job vacancies that are available in these 17 countries in the light gas data. That is quite comprehensive in terms of total vacancies of all countries. So there is a very large concentration of these tech-related ads in these firms, which are relatively large firms. Of course, the Fortune 500 firms are really large, but then also their affiliates, buyers, and suppliers and innovation partners tend to be also relatively large, and a relatively small set of firms accounts for a very large share of tech-related job ads, much larger than the share of total postings. So there is a big concentration on these firms. So we then examine this diffusion process from pioneer firms to other firms through supply chains. So we identify pioneer firms based on the definition of Bloom et al. Through each firm's zip code and industry code. So they use patent data to identify these pioneer locations for each technology. I'm going to show you a map in the US to show you where these technologies were located. And then we examine whether firms that were ex-ante linked to these pioneer firms through global value chains, that is whether they were a supplier, ex-ante, a buyer, an innovation partner, or an affiliate of a pioneer firm, see faster growth in hiring for that technology. Because the relationships data from FactSet starts in 2003, we restrict analysis to technologies that emerged from 2005, and we use the 2 years prior to the emergence year of each technology to capture the pre-existing firm-to-firm linkages. Okay, so and we are able to then control for firm, year, and technology fixed effects. So pioneer firms, even though we are considering technologies at a global level, pioneer firms are, and we confirmed also looking at patents data that these technologies identified by Bloom are also leading technologies at the global level, not just at the US level. These pioneer locations are clustered around the east and west coasts of the United States. So for example, for social networking, we have that they are clustered in these very specific locations, machine learning as well. And so they tend to be clustered here. So the process is essentially identifying firms, pioneer firms, which are we're going to take as firms that are from the industry of this technology and located in the zip code of where these technologies emerged. And these are what we call pioneer firms. And then we are also able to know which firms were ex-ante linked to these pioneer firms, both within the US and in other countries. And we're going to examine the diffusion process as measured by job ads, both in these firms that are pioneers and through other firms. To give you some summary statistics of proportions were accounted for by each type of firm. So pioneer firms account for about 20% of the total firm level data that we have. And then about 77% are suppliers or were suppliers, 5.7% were buyers, nearly 20% were affiliates, and 4.5% were innovation partners. The data also has information on firms that were identified as competitors. We didn't use this information for now. We believe that these are a bit less reliable in the sense that competitors can be defined in very different ways, while these are kind of more conceptually more, yeah.
So the suitability of those technologies, vary across locations and types of firms within locations. You want to do as good a job as you can to compare like the same firm. Like if you're close to a machine learning innovation center and you are in tech, and then you see that it flows as a negative function of distance, while there's less tech firms, as you go away from San Francisco, and then you see that it's more likely to flow to firms that are in tech relationships with you, than trying to take out the heterogeneity in the types of firms. And like you want to compare the same firm at different distances, and then the same firm.
Right. So, I mean, at this stage, our objective, and also following the Bloom paper is a paper on stylized facts within the US. Our objective here is more about documenting these facts, cautioning the reader that we are not fully able to.
Yeah, but like the more you can control for establishment characteristics in the firm data that you have, right?
Yeah.
The better.
Yes, I mean, we're going to include firm fixed effects. And then, so I'm going to show you so the specification that we use follows what was used by Bloom et al. They just used, in a small section they have on firms, they use just these two variables. Basically, you have a pool data on firms, and you identify whether the firm is a pioneer, and then you look at whether this firm has an advantage, and it does have, and then you see that this advantage dissipates over time. Okay, so this is the interaction between pioneer and the year since emergence, and you see that the firms have a strong initial advantage, but then it dissipates over time. And so accounting for technology, year, and firm fixed effects, we then look at whether firms that were ex-ante buyers of these pioneer firms also see a faster take-up in these job ads. And we do see that this happens.
Yeah, that's where, are the buyers the same as the non-buyers? Like that's
I mean, from a conceptual perspective, all trade models will tell us that they are not, right? But I think without this evidence, you wouldn't be able to then develop models that would account for better firms selecting, becoming buyers. And so we are not able to disentangle fully causality, but I think this evidence goes one step forward in terms of telling us that the firms that are buyers see a faster take-up, and then I think you have to do more research to understand why that is the case, and if it is a causal effect purely of becoming buyers or not.
Yeah, if you have a vector of observables, you can just throw it in and see what happens.
Yeah, and we do, for now we didn't include, but we can do that for sure. So we see that when introducing these variables separately, we see a positive correlation for being a buyer, a supplier, innovation partner, but some of these firms that are buyers are also suppliers. So when we introduce them all together, a robust pattern that emerges is that firms that were buyers or innovation partners before the technology emerged see a much faster take-up. So this diffusion process happens progressively over time. So these firms remain with a strong advantage in terms of having a much larger share of job ads than any other firm, but this dissipates over time, and it appears to dissipate to firms that were ex-ante linked to these firms. We don't see, possibly because of the length of our panel data, we don't see a big decay in terms of this influence of, but we do see already some with respect to buyers.
Paulo?
Yeah.
Quick question. these are private firms, right? Because in the US, you have universities, labs, government agencies pioneering a lot of new technologies.
These are private corporations. Yeah.
Is there a way to, do they have job ads? Is there a way to kind of, does that matter in this context?
No, these are private corporations. I don't. I mean, I didn't look in specific to that. But I don't think the fact that it covers university.
Okay.
If it were, it would be only. Location relative to the pioneers that determines this diffusion process. It's above and beyond distance that you see this effect on or this faster take-up of tech-related job ads. The data also allows us to see whether these buyers were buyers that belonged to the same organization or they were actually outside the organization. So most firms in our data were outside the organization. So these are firm-to-firm relationships outside the organization. But we're able to see whether these patterns occur more strongly within or outside. And we see that they are driven by relationships outside corporate boundaries. So they are buyers that did not belong to the same ultimate owner. And the same with innovation partners as well. Yes, but we're going to look in a table I'm going to show to see whether the result is specific to the US or not. We also are able to see whether the same firm can be not just a buyer or a supplier, but have multiple linkages at the same time. And when we do this, we see that being both a buyer and a supplier outside the organization is, again, positively correlated with the take-up in tech job ads, and the same with innovation partner. The only difference here is that, again, if you combine suppliers with some of the variables that were already picking up faster growth, you see as well there. So it seems that in most of the analysis that we have done, the key variables that determine whether you see a faster take-up, once you control for some fixed effects and once you control for different distance, is really being a buyer or innovation partner of these pioneer firms. So a question that already arose is, are these just within the US or not? So the paper by Blum et al. Focuses within the US, and they document a lot of diffusion through this strategy of looking at job ads within the US to regions that are closer to where the technologies emerge. But we see that this effect of being a buyer is not stronger if you are a buyer within the US. It actually happens irrespective of whether you are in the US or not. So if it were driven just by US firms, then once you include the interaction with the US, it would be strongly significant here and would potentially lose the significance of the variable itself. But it doesn't happen that. So we see that it happens irrespective of whether you are a firm that is also located in the US or not.
And all the innovations are in the US?
All the innovations are in the US, exactly. All these new technologies, these 29 new technologies emerged in the US. We also worry that maybe there is something specific about a particular innovative region in the US and the linkages they have. The Silicon Valley, of course, is a key origin for many of these technologies. So we excluded the firms located in the Silicon Valley to see whether they were driving the patterns. And again, we didn't find that to be the case. So it seems a robust finding across multiple sources of these technologies and across multiple technologies, because by doing this, we're also restricting the set of technologies to those that were not originated in the Silicon Valley. So there is this evidence that if you are located in these areas where the technologies emerge, you have a much stronger share of job posts related to that technology, but this dissipates over time and dissipates more faster to firms that were already linked with you in the beginning. So we didn't find, when looking at affiliates separately, that they saw faster take-up in this adoption of these technologies. And so we wanted to see the extent to which some of these buyers might also be affiliates, or some of these innovation partners might also be affiliates. And again, we don't see that affiliates being or not an affiliate, which is consistent with the evidence that we presented before on links outside corporate boundaries and inside. We don't see evidence that this faster take-up of buyers and innovation partners of these pioneer firms is mediated by being or not an affiliate of these firms. We also interact, again, to account for the effect of distance potentially affecting this interpretation of the coefficient on buyers and innovation partners. We interact distance with both pioneers and all of these variables for buyers and suppliers. Again, buyers remain, the coefficients on the interaction are not significant, and buyers remain very significant. Here, the innovation partner coefficient becomes a bit less precise, but it's still positive, and the only thing that changes is that suppliers also become significant and positive. So I think I'm actually doing well on time. So to conclude, we used this new merged data on job ads from 17 countries to infer technology adoption from job ads. We have a panel dimension that allows us to track this proxy for technologies over time. And we do it both at the country, region, industry, and firm levels. The key novelty here is that we are able to not only have this analysis for multiple countries, but also link it to firm-to-firm linkages data. It has a rich set of information on what type of linkages firms had to begin with. We corroborate prior evidence in the literature that distance and income per capita matter for the diffusion of these new technologies. But we uncover this, the first evidence directly, we believe, that these international firm-to-firm networks also appear to be playing an important role above and beyond distance, above and beyond income per capita. And once you account for firm-fixed effects, you see that these networks appear to be a channel by which these technologies flow to other locations, flow to other countries. There is a strong concentration on Fortune 500 firms and their supply chains, and firms that were exempted buyers and innovation partners of pioneer firms for technology before it took off subsequently saw a faster growth in technology diffusion. Importantly, these patterns hold globally, not just within the US, and so we can be more confident that it is indeed global value chains as opposed to national value chains that are channeling this process of technology diffusion. Of course, a lot of work is to be done either by us or by future researchers to causally estimate the impact of these linkages. But we believe that this is an important first step to uncover these stylized facts on diffusion, which is inherently a descriptive process. So diffusion is a process by which a technology that emerges then spreads across economic agents, and we were able to document it for the first time using this rich data on firm-to-firm relationships. But we believe that this approach, even within countries like Katherine has done some work on with job posts and state within India, for example, you can use this approach to then tackle more precisely issues of causality and try to identify more precisely these effects. But the objective of this paper was really to highlight these important patterns. I look forward to the discussion and to the talk.
Thank you very much to Anna and all the organizers for inviting me to discuss this paper. This paper is about firm networks and global technology diffusion. At some point, I would like to change it to diffusion of actually emerging technologies, because that's what it's focusing on. It's a lot of work being done here, and you're going to see how my comments are sometimes about like how cool some questions that I have, and also some ways to bring the question alive through the paper. So the question is, what is the role of firm networks on the process of spatial diffusion on emerging technologies? So these are these new technologies that Bloom and co-authors have developed this very rigorous and not methodology to bring alive. And this question is of first order importance in the literature of international trade and multinationals. It's basically what we do. I mean, how many papers have been devoted to try to understand how trade transactions across borders actually allow diffusion of ideas. And here we are just taking a look to emerging technologies, but this is a long-standing question, and many people have looked at this from different perspectives. So there is definitely a large literature on this. And I'm going to not do justice whatsoever, but just go through some of these issues. We know that supplier can benefit from global value chain participation, not only because they can secure some sort of demand, but because also they are receiving productivity enhancing transfers of technology, or also through other intangibles, right? And we have recent papers showing that that's the case, or that could be the case. But others also, there are even very more recent papers talking about something that also the literature has been focused on, is how the geography and barriers to free flows of information can shape the rate of knowledge diffusion. Actually, some of these papers what are finding is like when you lift some of those barriers to that flow of information, what is happening is like the linkages that are stronger are actually the ones that benefit the most from those relaxations. And also, I mean, we know like by case studies that there are some type of multinationals or organizations that are going to be very hesitant towards diffusing technology across different suppliers. But it's also the case that there are other firms that are going to invest tons of resources in building a very complex and deep number of suppliers, so they can actually rely on them, even if they don't have like a direct control on them. That is part of what we're going to work here with the networks approach that Paulo and co-authors will have. And not only that, but there is consequences of this type of innovation. For example, a novel consequence of having imitation risk is that firms can innovate selectively, for example. I mean, the fact that you have these emerging technologies and that you have the risk of imitation can make you to just switch to technologies that can be, or varieties that can be very short-lived, but they are going to be very hard to imitate before obsolescence of those varieties. So that could be kind of also a consequence that can generate a sort of reverse causality. So there is many approaches to this question. Now, the question that the paper that is going to be the closest to the approach that the authors are taking is going to be Bloom et al. 2021, that is the diffusion of new technologies. And basically, there are three big pieces that are being used for this type of papers. One is knowing what are the emerging technologies and figuring out which are those using patent data, in particular USPTO, because Bloom is focusing on the US economy, but because also almost every patent is going to be filled out in the US because it's a big market. And also you are going to measuring technology pioneers. That this is something that actually, there is a part where it's going to differ in this paper based on Bloom's paper. That is like the way, for example, to choose a location to be pioneer is like you just get all the patents and you organize the patents from the location that has more patents to less patents, and you just cut until you get all the locations that account for 50% or more of the patents. So you may have 3 locations, for example, in my little example here, that are going to be pioneers for that given technology. And in the main paper, they're going to have 29 technologies, and they're going to use this proxy for technology diffusion, which is, you know, is an approach which is going to be using online job posting through Lightcast dataset, which has starting in 2014. and it was previous burning glass technology data set. And they're going to take the approach of getting a normalized share of the technology jobs that you have, those that are going to be based on the emerging technologies, and you're going to just understand how much of that, let's say, location in technology T in time T are going to be how many technology jobs are being posted relative to the overall jobs that you have, and then you're going to normalize through the entire universe, that you are accounting in that case, just to have a sense of how they distribute. Now, there is this is the timeline for the emergence of the 29 technologies. So as Ben was referring, they are kind of broad in some sense, but they are picking up through diagrams from the patents filings. And actually, in the most recent version, they have like about 1,100 different technologies, and actually go way older than these ones. And again, this is just a representation of that, but now actually you can think about like they are more specific in the type of technologies that they are using. In this paper, we are adding two very important parts to the pieces that Bloom put together. One of them is actually that you are going to have a firm-to-firm relationship through the fact data sets. Again, it's like Orbis, but it's going to have also this understanding of who is part of your network. You don't know what you are trading, but you know that you are actually part of the customer set. And here is not as easy, and we know how hard those things are. I mean, I don't know exactly, but I think I know how hard it was to put this together and doing a fuzzy match for this. But for example, one of the things that was not clear to me reading the paper is that this is supposed to start in 2003, but going with global coverage since 2014. And this is going to be important because what you want to know is which firms have the network, like having a network or a buyer-seller relationship prior to the emergence of a given technology. And the other piece that they're going to have is like actually this is going to go across borders, right? So it's going to have that sense of international trade that is something that we care about. One thing that I would like to see more details on is that in the way that Paulo and co-authors are going to define what a pioneer firm is slightly different than what Bloom is going to do. What Bloom et al. Is going to do is like they're going to again take a look to the overall set of firms that are accounting for most of the patents in that given technology. And so you're going to have all those firms that file the most. But in this case, actually, it's going to be different. You're just going to get every firm that is in a technology or in a sector that is being defined as a pioneer, and at the same time is in a location that is defined as a pioneer. You're going to tell them, you're going to set them together, and you're going to say those are pioneer firms. And this could have, it's just a different definition, and for a little bit of an exercise I did, it could matter for the results. So there are, let me go a little bit fast because we just have 5 minutes, but there are two exercises that is coming from the previous literature. One is just trying to understand the global dispersion of emerging technologies. This is just basically that ratio that I show you, and you get the coefficient of variation of that, and you just regress it to how far away the emergence of technology is in the past relative to today. And there's another one that is pioneer advantage. You want to know how much advantage the pioneer has and how much that advantage goes away or decays with the pass of time. And what you get is that, I mean, in here will be great to know the constant of these relationships, because what you kind of want to know is how many, for example, how many years it's going to take zero advantage. For example, sorry, this is not zero advantage, this is getting the coefficient of variation to zero. So to simulate how many years we'll get or you will need in order to actually reduce every disparities in the use of technologies across years. And one of the main results of the Bloom's paper is like it takes a lot of time. I mean, it is true that the technologies diffuse, but very slowly. And he sees that as a problem, and so one is going to try to understand. From the paper, I would like to see more that, what is the stance in that case. And in the Bloom coefficients, as I said, you're going to have 54 years, and you're going to have a rate in which you are going to decline or diffuse of like around 2%. In here, this is going to be Paulo's estimates. And if you take the second equation that I said that came from previous literature, and you want to see how much advantage pioneer has and how much they move in that sense, you're going to see that you have an implying zero, you get zero advantage as a pioneer after 22 years. That in the previous literature is going to be about twice that. So, and part of, given that this is at the firm level and this is also at the firm level, it may be that part of that is coming from the fact that it's a slightly different definition of what pioneer has. And the number of pioneers are going to change massively depending on what definition we choose. The two things that I think, the two parts that are very cool in the paper, and I think is where the most of the value added is when you actually take to the geographical proximity, that is something that Bloom doesn't explore, and also the firm-to-firm networks. So I will do a different type of specification, and I agree with Ben, right? This is very difficult to get fundamentals from this type of data sets, actually, like that you can have time variant, so you can control for industry and size beans and so on. But will be just nice just to replicate kind of a regression similar to what you have in the previous setting, rather than the one that you have at the top, that is the one that we have at the paper right now. And you can see how much actually this distance doesn't go away. And it doesn't. So I think that that's very interesting. Distance matters, but it doesn't decay. I mean, it doesn't wash out. So it makes sense to me that Paulo and co-authors are gonna say, oh, let's take a look to these relationships. Because if distance matters, you say, well, if we're thinking about distance, this is actually trade. It could be trade, right? It could be that it's just because we want to understand if we're part of the same network or not. And in this case, here is just going to be a dummy of whether that buyer, here you have if the firm is a pioneer itself, another you have whether there is a buyer or not. And I mean, if you do the exercise, I just got Compustat, and I did the exercise using the relationships that you have in Compustat, because it's just the thing that I could have available. And you have, for example, that the advantage that you are losing is like about 11 years if you get the data and you use the definition that Bloom has in their paper. And this is if you do also the supply chain exercises using Compustat. But just let me, one thing that I think requires a little bit more explanation is that what is happening with affiliates. Because given that distance is so stubborn in the regressions and they don't decay with the passing of time, then, and you know that network actually is doing exactly the same. I mean, the advantage of a buyer is huge, but actually that advantage you don't lose the advantage with time. You may think that multinationals can actually have a big role there, right? They already overcome distance because they already are, exactly that's what they do. They are across borders. And at the same time, I mean, they are big distances and they are part of the same network. But we don't see any effect here. So I understand that you're taking that as a kind of as a result, but I think we'll look better into more deeply into what are the mechanisms behind. And one thing that comes to my mind is like in these data sets, defining what the corporate group is, it's not a trivial task. So it may be that that's what is happening. Just 2 more slides. One thing is about information technologies. I mean, a lot of these technologies are about information, and they are going to change the way that you relate to each other. If you think of how much internet has changed the way that firms do inventories, that's something that you want to take into account, because this is also changing the way that you relate in the networks itself. And a lot of a big share of this type of new technologies are in the information space. This is a very nice paper by Nico and Bastos about input diffusion and production networks that I think it would be great to discuss here. They are also using supply linkages using Compustat, as I did in the previous exercise. And they have different levels of proximity. Network proximity, that is if you are a buyer and seller. Technological proximity, that is if you are part or not of the same, the kind of like you are sharing the same sector. And geographical proximity. They're going to have actually that geographical proximity matters, as you do here. And the network proximity has a positive sign. What is cool about what they are doing is like they are not only taking one step at a time. You can also have linkages. I mean, the distance between firm 1 and 2 here is just 1, the same as here. But you also have like the fact that firm 1 and firm 3 can be related, and with a higher distance in terms of the network. And that could be another way to to still using the pioneer definition that Bloom has and kind of expand and be able to do regressions, because I know one of the things that you are saying is like you have very few pioneers when you get the definition of Bloom. And the other thing I think will be interesting to understand more is the network distance and relationship persistence. Here we are taking every buyer and seller as being the same, but it should not be the same if I just trade with you one or twice versus if we have a long-standing relationship. So we may be able to disentangle this from the data. And those are my main comments. Thank you.
Thanks. You can respond quickly, and then we open up for questions.
Thanks a lot for the comments, very useful, and we'll take them very seriously. Just to explain some of our choices, indeed the definition of pioneer is a bit different. We took a broader definition because of our focus on international diffusion, and we have this international firm level data. Cost to pay is that we have much less firms in the US. So if we were to define more narrowly the definition at the firm level as in Bloom et al., you have a very small number of pioneers. So conceptually, we believe that this is not incorrect, given that there is, even in Bloom's paper, a very strong evidence that there is a very strong diffusion within these very small geographical areas and within the same sector. So kind of we are, in a way, not looking at that first step of diffusion, but kind of taking that as given and then looking at the more broader diffusion either to other regions in the US or to other countries. So that was our choice, but given also the limitations of the data that because of its international nature is not exactly the same as Bloom's paper for the US alone. They have indeed a new version, a very recent new version of technologies and biograms. This was developed after we submitted the paper, and so, but we have been looking, and reassuringly we find that when we look at the main technologies that are coincided, which are actually the ones that account for the majority of jobs, we find very similar patterns, so we can include that as well in the revised version of the paper. And all the other suggestions are great, so I think we can address them, and we'll do our best to account for your comments, and thank you very much for the insights.
Okay, great. Let's gather a couple questions. Karen, you can start.
Super interesting work. I would encourage you to unpack the geography a little bit more. For instance, put distance in bins, because it may matter whether you are within 1 day driving distance or not. Maybe bilateral direct flights that could have a big impact. So anything you can put more content into distance would be great information.
Could you or did you just like the sectors of the firms who adopt, like, do you know those, or is it complete like unknown, like just like sector fixed effects to make sure that the buyers are not all tech firms rather than manufacturing firms, like that stuff?
I mean, we do have we include firm fixed effects, and the firms don't switch sectors much, but it's not the same, I believe. Yeah, I understand your point. Yeah, we can do that.
Great. Any other questions? Okay, looks like we're good on time. Okay, let's get started with the last paper, the distributional effects of carbon pricing.
Okay, so thanks everyone for joining this last presentation. Thanks for including our paper in this amazing program. So this is joint work with Dora Simon, who's also here at the conference, and also Mathilde and Simone in Zurich. So I'm going to talk about the distributional effects of carbon pricing. This is a quantitative analysis with a focus on the principle of common but differentiated responsibilities. So climate change is is the biggest challenge of our time. This is a global externality that is caused by the emission of greenhouse gases in the atmosphere, but today it's well understood that's not going to affect all countries the same, and actually low and middle income countries are going to suffer the most. For example, there's this recent paper at the QJE that estimates the relationship between changes in temperature and mortality for a lot of countries, and they extrapolate their estimates to countries that do not have a lot of data, and also to a future with climate change, and they find out that low and middle income countries are going to suffer the most because they're going to observe an increase in mortality, whereas high income countries may even benefit from changes in temperature, as they will observe in the future fewer days with, that are very cold, so they have a decrease in mortality there. So this is troubling because historically, low and middle income countries, they are less responsible for climate change as they have emitted less greenhouse gases to the atmosphere. For example, here we have a chart that shows the relationship between the share of historical emissions per capita and GDP per capita for many countries. So in green, we have high-income countries, in blue, middle-income countries, and in red, low-income countries. As you can see, there's a very defined and positive relationship between those two variables, with countries that have started emitting greenhouse gases like early in the 19th century at the onset of the Industrial Revolution and became richer afterwards, being responsible for the higher, for the most of the share of emissions per capita. If we have absolute numbers here, we have some changes, like China become one of the biggest contributor to the cumulative stocks of emissions, but still, like the big picture is the same. Like we have high-income countries more responsible for climate change than the other countries. So those two facts have led low and middle income countries to push for differentiated contributions in the fight against climate change that recognize that they will suffer the most while having contributed the least to the problem. And this idea is summarized in the concept of common but differentiated responsibilities, which is a key idea in international environmental law and global climate agreements. So the common part of the concept acknowledges that all countries, they need to face, they have a duty to face environmental destruction because it's something that affects everyone, everywhere. And the differentiated part of the concept acknowledges that countries have different types of responsibility because their historical contribution to the problem was different. So this principle has been around for more than 30 years. It was first established in 1992 at the Earth Summit in Rio, and ever since has become one of the leading principles of climate talks, such as the Conference of the Parties. I mean, it's a quite controversial idea. High-income countries, they're not very comfortable. So this is one of the reasons, for example, why the US didn't ratify the Kyoto Protocol. But since then, I think both sides have become more flexible. And for example, the Paris Agreement was built largely around the idea of common but differentiated responsibilities. And at least in the context of climate finance, usually high-income countries, they tend to support CBDR, acknowledging that they need to transfer resources such that low and middle-income countries can implement climate mitigation policies. So what we do in this paper is try to inform this debate about equity, global equity, and climate action by asking what are the distributional effects of climate mitigation policies across countries. And more specifically, we want to explore if there is a case for differentiated contributions in the fight against climate change in the spirit of this principle of common but differentiated responsibilities. And we do so in the context of a workhorse trade model, a multi-country, multi-sector international trade model with climate policies, input-output linkages that spans the entire world economy and the bulk of global emissions. So more specifically, what we do in this paper, so we establish a benchmark that asks what are the consequences of policies that disregard any geopolitical consideration, and more specifically, the principle of common but differentiated responsibilities. So this involves a scenario in which countries adopt a single price for greenhouse gas emissions, a global carbon tax, a Pigouvian-style tax that economists have long advocated as the optimal policy from a global standpoint. And it's also a popular proposal among policymakers and experts. So we document that this policy is very efficient in reducing greenhouse gas emissions, but it has a lot of uneven effects for countries as they heavily penalize low and middle income countries. So next, we ask whether efficient climate action can actually deliver equity, and we estimate this by pairing this global carbon tax with international transfers that seek to socialize the costs of carbon action, of carbon mitigation policies across countries. So the idea is to quantify those international transfers and to see if they're actually they make sense, right, in face of the numbers usually involved in climate finance. So we explore two scenarios, one in which those transfers, they are calculated to equalize the present costs of global carbon taxation. So basically, this scenario does not account for historical responsibility, but at least it makes sure that low and middle income countries are not paying the higher costs of climate action. And then we check a second scenario in which we compute transfers that are proportional to the accumulated cross-country greenhouse gas emissions since the Industrial Revolution. So like attributing some weight to the historical contribution of different countries to the cost of climate action. And then next, we analyze some prominent proposals for carbon taxation that appear in the policy debate and that rely on heterogeneous pricing. So those proposals, they're usually seen as more, compared to a global carbon tax, for example, as more politically feasible because they involve the coordination of policies among a smaller number of countries, and also as more fair because they decrease the burden of the carbon taxes that it's required from low and middle income countries. So we're gonna check if this is actually the case, and we check mostly two sets of imports that are coming from the rest of the world inside of the bloc are have their carbon content also taxed. It would reflect, for example, the EU ETS and the carbon border adjustment mechanism that is being currently implemented. And we also check this recent proposal by the IMF for a carbon price floor, in which we have either like a group of countries or the G20 or all the countries adopting a carbon tax, but this carbon tax varies according to the level of development of the country. So low and middle income countries would adopt carbon prices that are lower than high income countries. And then we check whether those settings, they actually deliver more fairness or they are more efficient when compared, for example, to a global carbon tax that delivers the same reduction in greenhouse gas emissions as those policies.
Can I ask you something? So,
Sure.
so this stock of emissions, there is no notion of depreciation, like the fact that 1 unit of emission 100 years ago is having some impact today. Like, is there any of these notions, or we just should think about no depreciation at all in these emissions?
You mean in the...
What is the impact of emissions today, yesterday, 100 years ago, into what we think of today as being climate change?
No, we're just looking at the accumulated stock of greenhouse gas emissions.
Notion in CBDR, is that directly linked to the stock?
Yes, yes, yes. So our analysis delivers three main insights. So first, we document that this a policy that disregards geopolitical considerations and the CBDR strongly exacerbates between country inequality. So this is like the optimal policy setting, right? So it's a very efficient policy. So we work, for example, with a benchmark tax of $100 per ton of CO2, but our results are robust to setting this policy at different levels. But for this benchmark, we observe that emissions decrease by around 28% at a very low cost for the global economy. So real income on average decreases by only 0.7%. But those aggregate numbers, they hide a lot of heterogeneity behind them. So we have that low and middle income countries, they often experience larger real income losses of up to 7%, while some high income countries actually experience some real income gain. So what's happening here is basically that low and middle income countries, they have some absolute disadvantage in the production of green goods. And as the carbon tax internalizing relative prices the environmental cost of carbon, then a lot of the resources flow to those green sectors which are disproportionately located in high income markets. So we document this uneven impact of the policy, and then we quantify like what are the transfers that would be necessary to equalize the cost of carbon taxation, and we a bit surprisingly, we find that there are some modest transfers from the global north to the global south actually would be sufficient to equalize the climate action in the different scenarios that we check. So, for example, on average, only $200 per capita from the global north to the global south would suffice to remedy this situation. And this is not very far from the current pledges of rich countries transfers of resources to low and middle income countries so that they can implement those climate policies. Yes. And then last, we check like those heterogeneous pricing schemes such as the Climate Club and the IMF, and we see that they do not necessarily lead to fair outcomes and lower costs. So despite the fact that they're low and middle income countries are adopting no carbon taxes here, or the carbon taxes that they are adopting are much lower than the rest of the high income countries, they're still pretty much hurt. And I think it's an important point that we document because of the linkages between countries through trade and supply chains. So, for example, a climate club with key global players that are necessary to lead to some sufficient decrease, substantial decrease in emissions would require more transfers when compared to a uniform tax benchmark that leads to the same reduction in emissions. And the IMF's international carbon floor pricing, when they're adopted by all countries, they do reduce the need for transfers, but they have a much higher high income cost to the economy when compared to the uniform tax benchmark. Okay, so in terms of our contribution to the literature, to the best of our knowledge, I think we're the first to provide this comprehensive quantitative analysis of the distributional effects of climate carbon pricing. There's an emerging literature that do look at the distribution effects of both climate change and carbon policies, but they're mostly macro models focused on a closed economy setting. So I think our value added here is to add this cross-country dimension to this type of analysis. Of course, there's a lot of literature on trade policy and greenhouse gas emissions, including like some quantitative models. I think we bring some equity dimension that is often overlooked in this type of analysis. And also we have points in common with this integrated assessment, the literature that use integrated assessment models, and we bring some international economics dimension to the analysis of the costs and benefits of climate policy. So for the rest of the talk, I'm going to briefly present the model, which is very standard quantitative trade model, discuss the data, and present the results. So we use a workhorse trade model. It's a many country, many industries Armington model that account for input-output linkages. And in the model, countries have an option of climate policy, which is a carbon tax that is imposed on final and intermediate goods. So a carbon tax that is applies over consumption in destination J of good S prime that is produced in origin I is going to be the dollar amount imposed on CO2, on a ton of CO2. For example, the $100 ton of CO2 that we use in our benchmark times the emission intensity of the production of good S prime in country I, which is basically the total amount of CO2 that is emitted during the production process divided by the value of production. So we calibrate the model with data on emissions per dollar of output. So this tax is paid by consumers that demand final goods, or by firms when they're purchasing inputs, and then they're redistributed lump sum to consumers to households in each country. We have a version of the model in which the tax is paid instead by the producer. Qualitatively, the results are very similar, so we decided for this setting. And also importantly, there's no change in technology in the model, so this is a static model, so we will not have change in technology as a response to the carbon tax. So in the counterfactuals, the emission intensities are going to be kept fixed. So we see this analysis more like what can be done in terms of carbon policies with the current state of technology that we have today. So more like a short run analysis. So for the preferences, so we have very standard preferences for consumers that have Cobb-Douglas CS preferences over varieties that are coming from the different countries. This Cobb-Douglas nest aggregates varieties that are coming from different sectors, and the CS nest aggregate varieties that are coming from different countries, and this is subject to an elasticity of substitution. In equilibrium, we have very standard CS demands that relates to the consumption of each variety, to the income in the destination country, the price index, and then the bilateral prices, which are gross of iceberg trade costs, of course. And it's worth highlighting that the carbon tax is going to be heavier on browner goods or more carbon-intensive goods. So what it does, it induces consumers to substitute away from those more carbon-intensive choices towards greener ones. Is country sector specific, yes. And then we have the equilibrium that the income in each country is basically the labor income plus the tariff, the tax revenue coming from the taxation of final goods and of intermediates, and we have a deficit that we keep fixed in counterfactuals. So the firms, also very standard, we have this roundabout description of an economy with input-output linkages. So production function of a firm is a Cobb-Douglas aggregation of labor and the composite of intermediate goods across different sectors, and this composite is a CS aggregation of inputs that are coming from all the different countries, also subject to an elasticity of substitution. And just as with final demand, we have an in-demand for intermediate inputs that has this CES shape. And again, the carbon tax is going to make the browner inputs more expensive, so firms are going to substitute away from those more carbon-intensive inputs towards the greener ones. So this is all for the description of the model. So to count to compute the counterfactuals, we use exact height algebra, which is now standard in the literature. So this involves rewriting the equilibrium equations of the model in terms of changes from the baseline, and then expressing the coefficients in terms of trade shares. I mean, this is convenient because we don't have to recover parameters that are difficult to observe in the data, such as trade costs or the productivity parameters or the preference shifters. And it also makes sure that the model perfectly match on the baseline the global pattern of production and trade. And we estimate the elasticity of substitution using the same data that we use to calibrate the model, but for a larger time span. I'm going to present the data next, and we use the methodology of Caliendo and Paulo. We also have experimented with alternative methodology, for example, the one proposed by Fontanier, the GIE recently, and the results, they are very robust, and the elasticity, they fall within the usual range in the literature. So respect to our data, so we have data on 64 countries and 45 sectors, including like the rest of the world, and also service sectors spanning the entire world economy. In 2018, we used data from the OECD, their input-output tables. And for data on greenhouse gas emissions, we combined 3 data sets that covers emissions with CO2, methane, and nitrous oxide. We have data from the OECD, the FAUSTAT, and the European Commission, and in total we cover, I think, 93% of the bulk of global emissions. Okay, so this is just a description of the emission intensities that we use to calibrate the model. So we have the different sectors of the economy, and we aggregate the service sectors here, and we have the distribution. So just highlighting that there's a lot of variation across sectors, right? So the average intensity is much higher for more upstream industries, for example, is lower for services, and we also have a lot of variation across countries. So basically the carbon tax is going to induce countries and firms and consumers to substitute like between the sectors and also between the countries. Okay, so it's going to be on the background of the results of the model. So this is the the policy that disregard any consideration about CBDR, the Uniform Carbon Policy. So we have four indicators of the global economy. So we have global emissions, real income, changes in world gross output, and changes in the share of output traded. And this is varying for carbon tax that go from 0, so in the baseline, world economy, right? That's, for example, for your real income, only 0.7% decrease. In our benchmark scenario, for world gross output, only 0.5% decrease. And interestingly, the share of output traded is very resilient to the different levels of the carbon tax, which tells us that trade plays a role in allowing for this decrease in global emissions by allowing countries, consumers, and firms to source from greener origins. But again, those average effects, they mask a lot of heterogeneity. And here we have the real income changes by country plotted against their GDP per capita. And as we can see, there's a very clear pattern here with low and middle income countries suffering the most of the cost of the carbon tax, and a lot of high income countries actually benefiting from the policy. So what is happening here is that low and middle income countries, they have their production structure pretty much specialized in carbon intensive activities. So more specifically, they're usually more upstream on value chains, so they provide those raw materials that are very carbon intensive, and they have a higher carbon content when compared to the other economies. So this also means that the consumption basket in those countries, they are also very carbon intensive, because a lot of the domestic expenditure comes from the domestic production, right? And also for all sectors, usually low and middle income countries, they emit more per dollar produced when compared to high income countries. So as the tax internalize the environmental costs of carbon, a lot of the output from those countries is shifted towards those greener sectors that are located in high. Almost all low and middle income countries, they observe a negative net change in output, whereas the high income countries, they observe a positive change. So a lot of the output is being transferred to the high income countries, which are gaining from the policy. Okay, so now we're going to discuss the transfers. As we saw, some countries gain, some countries lose from the carbon taxation policy. So there's a room for international side payments to equalize the costs of climate action. And we do so inspired by the transfer. So basically, in the optimal, we will have the tax addressing the externality, internalizing the cost of the externality, and the lump sum transfers, just making sure that every country is just as well off. So we build on this insight, and we explore two scenarios: an equal cost scenario that completely socialize the cost of carbon taxation between countries, the present cost, and a polluter pays scenario that makes the cost of taxation proportional to the historical emissions of each country. Sure. So we use the Kalyan and Paulo method. So basically, we use the trade shares that we use to calibrate the model, and we have data on tariffs to identify like those elasticities. Okay. And we use, so we calibrate the model with data for 2018, and we have the same data that I just described between 1995 and 2018. So we use the whole period to identify the elasticities. And on average, I think our elasticity is 4, which is in line with the literature, and I think the standard deviation is very low. Yeah, sure.
Sorry, remind me, is there a externality in the model?
No. There's no feedback from carbon to production.
I was just thinking how we can think about the Pigovian tax if there's no explicit externality in the model.
So we're not doing optimal tax here, so this is an exogenous. We're just using the argument that I mean, if you have a competitive model, then the optimal carbon policy is a uniform tax on all countries, but we don't solve for optimal policy here. So those are the transfers that we compute. So a negative number is an international side payment, and a positive number is an income gain. And as we can see in this equal cost scenario, we have high income countries transferring money to low and middle income countries. So I mean, the maximum amount of per capita transfer is going to be given by Ireland, and then for EU countries something around $1,000 per capita. And we have two outliers, which are Saudi Arabia and Bahrain, which are like heavily polluting economies that are relying a lot on oil. So in the carbon tax have penalized those countries. So if we're socializing the cost, then they need to receive some monies. But other than that, usually we have like the high income countries transferring money to the low and middle income countries, and of course the transfers there are much lower because those countries, they have a higher population. So in the polluter pays scenario, that is, the transfers are proportional to the historical contribution of each country. We'll have the same pattern. So a conclusion between the two scenarios, that a payer remain a payer and a receiver remain a receiver. We have like some slight changes. For example, Russia, which get a lot of transfers in the equal cost scenario, also because it's a very has a very carbon intensive production structure. But when we look at the historical contribution, Russia started polluting very early. So in this scenario, like the transfers it receives decrease by a lot. But I mean, the correlation between the transfers is maintained in this scenario. Okay. So about the heterogeneous carbon price policies. So as I said, usually those policies this is actually the case. And so to establish that, we compare those policies with a clear benchmark, a uniform tax that generates the same emission reduction as in the policy in question. So to judge the fairness of those policies, we pair them with equal cost transfer. So we're going to, for example, simulate like a climate club and the equivalent global carbon tax that generate the same emissions, and then we're going to compute the transfers that are necessary to socialize the cost of both policies, and then we're going to compare them to see. We're going to have a club of countries that adopt a domestic carbon tax and also a border tax. So we do not model strategic interactions of countries in this climate club scenario. So we're not gonna model, for example, retaliation of countries that are outside of the club who could not be like happy with the taxation of their products and could increase their tariffs, for example. So we're purely adopting exogenous policy setting here to try to study like the heterogeneous prices that can emerge from it. So we analyze the creation of a club with a critical mass of countries from the global north and the global south, the EU, the US, China, India, Indonesia, Russia, Brazil, and South Africa, because those are the countries that are necessary to deliver meaningful reduction in emissions. So here's how we choose those countries. So basically, we check by incrementally taxing the different countries how much of a reduction in emissions we get, and the order of the countries here is optimized, so we can always get the highest reduction in emissions. And when we observe that the moment we tax this subset of countries that we use for the Climate Club players, we already get 19% of the emissions of a total of 28%, so like 2/3. So we define this as a group of meaningful, of key players to design the Climate Club. We experimented with just a Climate Club with the EU, for example, but this does not lead to substantial emissions reduction because the EU is already a very green block of countries when compared to the rest of the world. Okay, and so we check what happens when those countries impose $100 per ton of CO2 carbon tax on their producers. And they also introduce this border tax to countries outside of the club, and the idea is that the other countries will not adopt any type of policy. And what we observe is that those policies, they also hurt countries that are outside of the club. So the low and middle income countries, they're not doing anything, but they're still being affected by this Climate Club policy. So you can think that here we basically have like this border tax, and those key players, they are important trade partners of the countries in the club. So they have like some terms of trade effect on their economies, which leads to a decrease in welfare. And some of the high-income countries, they continue to benefit from this type of. It's a $60 per ton of CO2 tax, and we show that the Climate Club would require 36% higher transfers than this fair tax equivalent, and would lead to 11% higher real income costs than this uniform tax equivalent. So conclusion is that the Climate Club, in this setting that we investigate, is less fair and less efficient than the uniform tax equivalent. So quickly about the IMF price floor. So this is a suggestion of a recent publication of the IMF. So it suggests different tax rates for countries depending on their income level. So in their proposal, you have 25% tax, $25 per ton of CO2 tax for low-income countries, $50 for middle-income countries, and $75 for high-income countries. And they suggest multiple scenarios, which we explore in the paper. I'm going to show a scenario in which all countries, they adopt those taxes based on their level of development. And this is the scenario in which the IMF proposal performs better. And still, it's going to have like a similar pattern of changes in real income as before. And what we compute is that this scheme is equivalent to $30 per ton of CO2 tax. I mean, it would lead indeed to lower transfer requirements with just 5.5%, but the real income losses would be higher than when compared to the uniform tax equivalent. So the IMF, for all the scenarios that they suggest, the IMF price floor will never deliver both lower transfers and lower real income costs when compared to this uniform tax benchmark. Okay. So yes, I think that's it. So in this paper, we conduct what we think is the first comprehensive quantitative analysis of the distribution effects of carbon pricing with this look at the principle of common but differentiated responsibilities. And we, and the analysis delivered three main sides. First, that a uniform carbon tax or policy that disregard any geopolitical considerations strongly exacerbate between country inequality. but some realistic transfers of an average of $200 per person from the global north to the global south could remedy this inequality. So in total, this would amount to almost $3 billion in terms of transfers from the global north to the global south, and this would be 3 times what is the current pledge of rich countries to transfer by year. So this is a quite considerable number, but still, I mean, if we think about the per capita numbers, it's not so, it doesn't seem so expensive. And those heterogeneous pricing scheme, such as the Climate Club and the IMF proposal, do not necessarily lead to fair outcomes and lower costs when compared to the equivalent global carbon tax benchmark. Okay.
Great, thank you so much. Ahmed, we have our last discussant and last round of questions afterwards.
Okay, so I'm very happy to discuss this really nice paper, and again, thank you all the organizers for putting this really nice conference together. So let me, because I have 10 slides and make sure I finish in time, let me just jump ahead and talk about a very general motivation behind the paper. And the way I'm going to do meaning that you have to offer side payments or transfers to the losing countries to make this a Pareto improving policy. And this obviously creates an important question, which is one, who are these countries that are more burdened by carbon taxes that need to be compensated? And how should we design these transfers to ensure fairness for the reasons that were discussed during the presentation? And this is a big issue. Like, this is just a picture there to tell you that when people are talking about climate action, this issue of justice is always on their minds. Now, is not taking into account the strategic incentives of governments to comply with these transfers or these carbon pricing schemes. But the positive side, I mean, that's obviously immune to this critique. So what this paper does is that it uses a quantitative trade model, a la Caliendo and Paro, to examine these two questions. And the way that the paper goes about it is using this exact algebra method, calibrating the model to the ICIO data. This means that carbon taxes that are efficient are going to exacerbate global inequality. But I thought that what was even more interesting was that carbon taxes plus transfers based on historical emissions have the potential to be Pareto improving. The paper doesn't obviously show this, but showing that there's potential there, I think, is a big finding. So I think this is a very promising paper, and it could be many papers. Like, I think this could be the start of a big research agenda, and it's a very important and underexplored topic. So I have 3 comments, and then I'm going to just give you a general summary of what these comments are trying to say. Comment 1 is about modeling of carbon emissions. So if you think about the standard approach in the literature, you basically use energy to produce. Energy is associated with emissions. Like, if you burn coal, you're going to emit carbon. And then there's an engineering constant between how much energy or coal, for example, you use and how much emissions you have. And then as a result, carbon intensity, which is carbon per unit of output, is going to be this endogenous thing, which depends on the price of energy, the share of energy in production. And when you implement a policy, this carbon intensity thing changes, right? So that's what we call abatement. Now, in this paper, the key assumption I think that is that bugged me a little bit was that the carbon intensity is constant, meaning that if you tax carbon, the firm cannot abate. They cannot use less energy, for example, to emit less carbon and pay smaller taxes. Now, but the issue, in my view, is a little bit more profound in the sense that if you look at the high carbon intensity of low-income countries, that is itself an artifact of policy. So energy is subsidized. If you look at these like red countries, these are developing countries that subsidize energy. So the reason carbon intensity is high in developing countries is that energy is subsidized, so firms have an incentive to use a lot of carbon in production. So when you impose in response to this policy. The other thing is, and this was surprising to me, because you mentioned that your demand and supply side taxes deliver similar outcomes. My intuition is very different on this. So let me just, and I could be completely wrong, I'd understand it. So this is what is assumed in this paper. This is more common, like the supply side tax. So a demand side tax is if you use carbon, you get taxed. A supply side tax is depending on the content of your production, you get taxed. So here's the way I see this. So a demand side carbon tax is kind of isomorphic to a domestic carbon tax plus an import tariff on carbon content. So it favors countries whose imports have a lot of carbon content because it's basically allowing you to collect tax revenue from foreign countries via carbon taxation. A supply side tax, on the other hand, is kind of isomorphic to a domestic carbon tax plus a tax on the carbon content of export. So this one favors countries who export a lot of carbon to the rest of the world. So my conjecture actually is that the burden of global supply side carbon taxes should fall disproportionately on high income countries because they are going to be paying carbon taxes to low income countries that are exporting these high carbon goods. So this is basically about the incidence of the tax. Like the supply side and demand side carbon taxes are going to have kind of intuitively mirror opposite incidences. But this is an easy thing to check. Like as you said, you can easily do it. But I think what makes me kind of also really want to test this conjecture is that if you look at who's the recipient of these transfers, it's these oil exporting countries. It's these countries that are really losing out because they're the ones whose exports are being taxed in this scenario. So the last thing, and this came up during the talk, I think Sebastian mentioned this, is that welfare, and you actually talked about this at the beginning of the talk, is real income generally minus exposure to climate damage. So we have to account for both effects. Consumption minus climate damage. Now, when you tax carbon, and this is the rationale behind Pigouvian carbon taxes, is that you decrease real consumption. It's an efficiency loss that happens, but in return, you get a benefit through reduction in emissions. So the optimal carbon tax basically equates the marginal gains from emission reduction with the marginal loss from real consumption. So what you show in this paper is that the carbon taxes lead to real consumption losses that are asymmetric across countries. But because countries have different exposures to this climate damage, the benefits from climate change are also asymmetric. So when you look at the whole welfare effect, the benefits are unequal because of the real consumption loss being unequal, but also the the exposure to climate damage being unequal. And here's the thing: when you look at like the recent paper by Cruz and Rossi Hansberg and Ari Stad, they find that high-income countries are the ones that are less exposed. Low-income countries are the ones that are more exposed. So when you look at the whole welfare calculus, yes, low-income countries are losing a lot of real consumption, but they're also disproportionately benefiting from curbing climate change. So when you take the whole effect, it could be less unequal, because the real consumption loss favors is against countries who also benefit disproportionately from reducing climate change. So overall, this is the overarching comment, is that I buy the headline result. I actually buy it. I think I'm very sympathetic to it. When we did our analysis, we kind of have the same feeling. But I do worry that the current specification may overstate how big this inequality-inducing effect is. So I have 3 suggestions. One is to incorporate abatement. So you can either do it using Coupland and Taylor, which is easy, or you could go through this thing where we did in our paper, which introduced energy markets, global energy markets. That's very difficult, and I don't think it's really necessary for this kind of analysis, because, to be honest, nothing changed in our paper when we went from this less complex to the more complex version. I would do the supply side. I would just report the supply side tax, and I just say that this is how it looks like. And also I would account for the country-specific gains from mitigating climate change to have the full picture, not just the real consumption loss. But on a more conceptual level, when it comes to the normative results, I think it's important to understand that the feasibility of all these policies is, at the end of the day, debatable. So, like, what deters welfare maximizing governments from free riding on their transfer commitments, free riding on their carbon pricing commitments? So I think when we talk about the Climate Club is clearly not the best outcome if we had full enforcement abilities. It's there because we cannot force countries to behave. So we have to find these levers that kind of penalize free riders. So I think that's kind of a tension there. When you're comparing policies that are have different degrees of feasibility, it's actually unclear what we are comparing. So I think that's something that maybe could be more clear in the paper, to say that at the end of the day, these transfers are really telling us more about how our final ideal incentive compatible policy should look like. But it could be that we will deviate from this because we need these mechanisms to penalize, for example, free.
And respond briefly while people get their questions.
Thanks, Ahmad. Just great comments and super interesting. For sure, we're gonna look very carefully at your suggestions. So we have I think very early in the project we discussed how to design the tax. So I think we have the results somewhere out there. I think at some point we convinced ourselves that it was not so different, at least in terms of the macroeconomic consequences, but I think we're going to take a look more clear at the transfers and how they change with the tax, and add this to the paper. About the uneven carbon damages, I think that we have discussed a lot about this, or how misleading just focusing on real income changes could be, because I mean at the end of the day those could be welfare maximizing policies if you account for the future damages of climate change. So I think we're just comparing. I mean there's a lot of new estimates of the carbon damages by countries, so I think that's something that we definitely do to compare our results with those estimates. And about the abatement, I think we have never done that, but for sure it's something that we can check. Is there some data constraint on that?
Not at the level of aggregation you guys are working.
Okay.
With ICIO you don't.
Okay. Oh, great. No, we'll definitely take a look at that. So thanks a lot for the comments there. Really helpful.
Great, perfect. So we can open up to questions on the floor.
Yeah, so I was thinking related Thank you. Super interesting paper. In addition to the point about abatement, I was wondering if you'd thought a bit about induced technological change and innovation effects. Obviously slightly longer term, but I was wondering also how much that would change the results even if you looked kind of 5 or 10 years down the line, particularly given the crucial impacts of carbon pricing on driving innovation and lowering the costs of technologies. So interested to hear your thoughts on that. Thanks.
Karen?
So thinking about justice opens up a whole new set of questions, right? Like we can kind of conceptually think about what exactly is fairness in this context. So let's say, to be a little, I don't know if anyone made this point, one can say, well, up until 1970s, we did not know. When UK and the, top of the Industrial Revolution was polluting like crazy, they didn't know about global warming and so on. But after 1980, it's really not, you don't have an excuse to keep polluting because we now know. I don't know if there are allocations of carbon emissions over time that could take into into account.
You give a lot of transfers, well, you could disincentivize firms or governments to actually become cleaner because then they get more transfers, which sounds great. So how do we think in terms of like more what Katherine is saying, like could we use these transfers money for investing in subsidizing renewable energy? Just kind of thinking of the dynamic effects. Might be a different paper maybe. It sounds like, which I would be curious to hear thoughts on, and exactly like Katherine said, like taxing carbon intensive technologies or subsidizing renewable ones should lead to innovation and give incentives to firms, versus transfers that are conditional on today's production functions would do the opposite. So I think we had one more question in the back I just saw.
Yeah, very interesting paper. I was wondering, given that you have the machinery with all of the trade linkages setups and all of the sectors, understanding maybe a little bit more how these transfers depend on degrees of openness, right? It seems like these poorer countries are specialized in very polluting industries, but it would be interesting to understand why. Is it that they have lower export costs? Is that they have a comparative advantage on those? Or should I think of a bigger model in which the institutions are weaker and therefore they're across the board more polluting? So understanding maybe those things can help design policies that combine reductions in trade costs or perhaps increases in trade costs with the transfer in a way that is like maybe more appealing to richer countries.
Okay, great. I think we can answer and see if there are more questions.
Okay, so about the technology changes. So I mean, it's a static framework, right? So we don't have like this. We do experiment with. So we have some data on the likely path of change in technology, like the carbon intensity of the different sectors. So we did experiment with that, but I think we haven't checked like the transfers, how they would be impacted by that. So if countries like low and middle income countries, they start having like some more comparative advantage or absolute advantage in the green sectors, maybe like the transfer requirements they lower with time. So we haven't checked that, but that's a great point we can do. About the emissions, when it's actually should we start talking about like the responsibility, right, of is it since the Industrial Revolution? I think we picked the Industrial Revolution because it's like when the data show that this starts to become a problem. So yeah, and I think it's how usually the debate is framed, but that's a good point. So I think we probably have data on that, and we can check if we like when is the starting point in which like the rich countries need to compensate low and middle income countries by their emissions. That's something we can check as well. so the transfers are from per capita from the global north to the global south. So this is the average for the rich countries, and then we compare in the paper with the current pledges that are also like rich countries are making too. So they're promised I think like a billion by 2025 or something. So it's that's how we design like this debate, this discussion in the paper. And you also asked what countries should do with the transfers. I think, yeah, we haven't gone through these details on the paper. I mean, that's an excellent question. I mean, should this be like just given to people so they can afford like the higher energy prices, for example, in those countries? Should this be used to buy new technologies? I think we haven't tried to explain this, but yeah, I think that's definitely something we can check.
Okay, thanks so much. Are there any other questions, or we are in perfect time also to wrap up? But maybe because this was the last session, let me thank all our presenters, all discussants, everyone for being here. And I think we had two very, very interesting days, but we have some longer concluding remarks still from Daria. But first, a round of applause to all presenters and discussants.
So let's see, we have to download. Download.
So, thank you for having all that so long. So I will try to make it short, but I thought just, okay, a little reflection of what we learned. And I think, I mean, a big picture, I guess, or at least my takeaways. So there are these different areas: trade, technology diffusion, infrastructure, that are all linked in this debate, and they interact with inequality. And the way they interact is not straightforward or mono-directional. And so untangling all these different interactions, I think it gives a lot of material for future research. The nature of these interactions matters for the pattern of structural transformation and development. So what are the main issues? And I'm sorry if I didn't pick all the papers. I think they all have some insightful contributions. But let's say there are 6 main takeaways. In some cases, some papers showed that there are same time, there are also an important role for pre-existing inequalities. In the paper with Paulo, Katherine, we tried to show how firm linkages intermediate the benefits, but there is also the paper by Moigne and co-authors on how spillovers of multinationals are limited by firm capability constraints. And the paper by Bengoria Safei Zhang showed how spatial linkages in Brazil can lead to a firm concentration, worsening regional inequality if there is not active policies for small business support. The first paper that was presented in the conference by Moigne showed how trade cost and productivity shock can cause deindustrialization, hence limiting the trade potential to reduce inequality. Then another big area was on the labor market responses. And I think this idea of the gender dimension is very important. And there are many interesting questions there on the sectoral biases, gender norms, affecting women's opportunity. But there are also similar questions could be asked on other type of social differences, different groups, social groups might be affected differently, and I think there is a lot that can be done there. The paper by Mitra and co-authors also pointed to this trade-induced mobility, again, that varies by gender, as the discussion highlighted, and that might have long-term impacts on gender equality. The uneven effects of infrastructure. So the paper by Kabowski, we just mentioned those, but there is also the paper, the Amit and co-authors, which showed how in infrastructure investment must be, at the end, the policy implication of that was that they must be tailored to the local context due to these uneven effects that are, again, not straightforward to capture and to generalize. And finally, in the paper we just discussed, the role of coordinated climate policies. So global coordination is needed, but similar conclusions can be also drawn for other areas where you have spillovers, and one was infrastructure. Okay, so there are a lot of questions also that these papers highlighted and that would deserve further explorations. This is not at all an exhaustive list, but to be discussed. But for instance, one is on, I think that was highlighted yesterday, was on the trade-off in diffusing low-carbon technologies for green transition in developing countries. So this trade-off of lifting short-term capital goods constraints versus the longer-term path towards development and a greener development. Labor markets and genders, all the issues about social norms, wage discrimination, and this important question that was discussed yesterday on whether female entrants are concentrated in low-skilled sectors and how they transition eventually to high-skilled industries. I think at the same time, while all these papers raised new questions and new ideas for research, I think that we can draw some clear policy implications, and there are four that I think are very clear. Need for data-driven. This is one conclusion that we always give to the rest of the bank. We need data-driven decision-making, but I think this is particularly true for the infrastructure planning. We saw that very clearly. I think on the diffusion of technology, clearly, trade agreements in combination with targeted domestic policies can assuage some of the inequalities that we see that we discussed during these 2 days. For the labor market, the implications for the labor markets in the dual objectives of industrial growth and environmental goal needs. I think it's something that, even if it sounds obvious, is not necessarily done. So with this, and I wanted just to take 1 minute to thank you all for really 2 great days. I think, I hope it's the first of many appointments that we will give to each other to discuss these issues. Thanks, a big thank you to the organizing committee, to Michelle, to Lubna, for having done flawless assistance for this conference. And thanks to you all for the very lively participation. Thanks.